Why is NIO stock going down? Alright guys, Mr. Investor Lot here. Today we're going to be covering why NIO has gone down so much in such a short period of time. So what we're going to be doing is we're going to be looking at who has been shorting the stock, what is the history behind these people, and what are their agendas. So there's many different articles that have been published, and they're basically talking about a company called Citron Research run by Andrew Left. So Andrew Left is a famous short seller, and he's been notoriously known for shorting stocks. As a fund manager, this is how he is known to make loads of profits for his fund. Before we begin, please smash that like button, and remember, I am not a financial advisor. Please do your own research.
Okay, here we go. Let's talk about NIO. So the famed short seller predicts a downfall for the Tesla of China's soaring stock. So as you know, NIO is an electric vehicle come out of China. It's exploded into popularity over the last few months. So let's look at the NIO stock. So these are the kinds of models that they currently have. They've got these sexy looking cars, very beautiful for electric cars. And they're bringing out this kind of futuristic look. Look at that, damn. So what we wanted to discuss today would be this short seller article on NIO. NIO has dropped a lot as a stock. So first of all, let's take a look at where the stock's gone. So across the year to date, we've seen the stock go all the way from $3.72, and it was trading sideways, going down a bit across March, April and May. And then we started to see the steady climb. So from the 22nd of May at $3.27, we started to see a steady climb as more people got interested in the stock, all the way up 330% by July. From July, we traded steadily up as well through August, and then we had a jump in September. Since then, it's been going steadily up day by day during September. October, it had a massive spike as well. And then finally, from November, it just exploded. And now it's become a very popular stock for EV. Looking across the whole period of time, we can see it's gone up 1,198%, nearly 12 times the money. And now, since one day ago, we saw that it rose all the way up to $53, $54. Look, nearly $54. And then all of a sudden, kaboom. Short seller report comes out and we lose 24% of value. That's literally 4 hours and 45 minutes. In less than 5 hours, we lost 24%. Then we've had a small climb back up to 44.
So you gotta see really what is up here. We have to find out the reason why.
So why is this happening? Who is this short seller? This short seller is predicting that NIO is going to fall down. The Wall Street seller who made his name and fame by betting against the then struggling Tesla 2 years ago has found a new electric vehicle target, NIO. So this company NIO is 6 years old, it's a startup, and it went public on the New York Stock Exchange 2018. It was on the brink of bankruptcy just 5 months ago. But since summer, NIO shares have been on a meteoric rise, shooting up over 1,000% from $5 to $53 as of Thursday's close. So this shot up so fast they actually alarmed analysts who said now it's a full-blown bubble and the bubble's got to pop. So this is our guy here, Andrew Left. Let's take a look at who Andrew Left is. So anyone buying NIO stock now is not buying a company or its prospects, rather you are buying 3 letters that move on a screen. Short seller Andrew Left said in a note to investors on Friday through his investment firm Citron Research. So originally this guy was actually bullish on the stock in 2018, and now he's starting to short the stock. So this is our guy here, Andrew Left, and we want to see what this guy is about. Why is he shorting this stock? What is his history and background? So if we look into this article here, we'll be able to see NIO tumbles 14% after the renowned short seller Citron Research makes a bearish call citing increased Tesla competition. So this Business Insider article is talking about an impending 48% crash according to Citron Research. So they published a short report. So here we can see the most important part of this article is Andrew Left of Citron Research said in a short seller report right here. So this short seller report is the one that Citron Research has published, and it says Citron pulls the plug on NIO 2 years after our controversial recommendation. So 2 years ago, NIO was trading at $7 when Citron recommended buying the stock as a company, and its charismatic leader, William Li, intrigued us. After a rocky road of trading, NIO's finds itself in uncharted territory that can never be justified by its current standing in the China EV market or its near-term prospects. So the recent mania of investors flocking to electric car makers in China shows no deeper understanding of a market that is marked by price cuts. What makes NIO most vulnerable at these levels are two main points. This being 1. Tesla Model Y China pricing. Worse, anyone who's buying the stock has obviously not been paying attention to Tesla and the price of the Model Y in China. The brand of cachet of Tesla and its pricing has become a big problem for NIO's ES6 hatchback model. Okay, so the gist of this article is basically saying that Tesla could materially cut the price of its locally made Model Y. So the original price was around $73,000 and they're looking to cut it down to something within the $56,000 to $58,000 region. So that being said, this could really hurt NIO's order book momentum, considering it's going to be now a direct competitor to NIO's EC6 and ES6. So the local Chinese analysts are predicting that Tesla's Model Y will be priced substantially below the key point, so that would be a threat to NIO. So they were talking about Tesla's strategy of passing its cost savings to customers could result in the made in China Model Y starting at a very low and reasonable and affordable price of $41,000. So the whole gist of the article basically surrounds Tesla and how Tesla could undercut NIO and provide lots of competition in China. It is also stating that NIO is performing at an astronomical rate, which means that it's 17 to 18 times above value. It's saying that NIO is trading at 17 to 18 times above value compared to Tesla at 9 times. So this is the largest premium to Tesla in history at double the valuation. Moreover, when Tesla was delivering a quarterly run rate of 15,000 vehicles, similar to NIO today, Tesla had 45% share in the US EV market, while NIO faces significant competition today and only has 3% of the Chinese market. The conclusion of the short article is anyone buying NIO stock now is not buying a company or its prospects. Rather, you are buying 3 letters that move on a screen. The China electric phenomenon is a real movement, but there are better ways to play it. Consider this. So they're saying Warren Buffett backed BYD that did $22 billion in sales and trades at 3 times their sales, even after they've been 400% up this year. And these levels are nowhere near the 17 times or 18 times that NIO trades right now. So they're saying in this short article that investors should rotate out of NIO. They're saying it's time to rotate, enjoy your profits, and look out for the next disruptive technology. That being said, they then go on to have a disclaimer. So you agree that the research presented in this report is at your own risk, and you or any person agree to hold harmless Citron Research, Citron Capital, and each of their affiliates. So basically they just relinquish all responsibility for any direct or indirect losses that you may gain from this research. They tell you to do your own due diligence and your own research. So next we want to see who is this company and have they been right or wrong in the past. So Andrew Edward Left is a short seller. He's basically an activist, an author, and editor of Citron Research, formerly known as StockLemon.com. So Citron launched 51 investigative reports against S&P 500 companies between 2009 and 2015, as well as several Chinese companies citing allegations of pyramid schemes, ineffective products, accounting or business frauds. In 2016, Left was actually banned for 5 years by the Hong Kong Market Misconduct Tribunal. This is for disclosing false or misleading information in connection with the publication of a research report on a Chinese property developer called Evergrande Groups. So let's take a look at his early life and career. So this is all on Wikipedia, but it actually states the sources of where they've got their research from, and some of the sources are major companies or major news outlets. So Left's first job with Universal Commodity Corp, a high-pressure commodities broker firm that hired salespeople to make cold calls and push questionable investments. Left quit in March 1994 after 9 months with the company. When the National Future Association sanctioned the firm in December 1998, Left, along with other former employees, was sanctioned for 3 years and being required to take an ethics training course as part of the probe into the firm making false statements to sell commodity future contracts. The National Futures Association stated that Mr. Left had made false and misleading statements to cheat, defraud, or deceive a customer in violation of NFA compliance rules. And let's check up where that's come from, and you get the globeandmail.com. So taking a look here, this article was written 2015, and it was just answering who is Citron Research. Citron Research is a research provider that publishes reports on publicly traded companies while simultaneously taking a corresponding short position in the stock. According to its website, Citron investigators have a track record in identifying frauds and terminal business models. Citron's reports are usually damning in tone, armed with provocative headlines, and followed up with a targeted social media push. So these are some of the companies they've shorted: Valiant and Wayfair. So if we take a look here, let's see whether they've been right or wrong about some of these companies. Let's take a look here. Wayfair is the most mispriced stock Citron Research has seen in years. They said the fair value is under $10. So let's check how Wayfair did. Oh, it's at $235 right now. And wow, if we backtrack it all the way to when they put out this article. So after they put out this article, we can see the effect that it had. They put it out in August 2015. The stock price dropped from $49 to $33. And since then, it's had a massive run up of nearly 1,000%. It's had the crash during the pandemic times, and it's still sitting at 613% up. Now let's look at this Bezinga article. Citron names top long and short ideas for 2020. So this one's January 7, 2020. And here they predicted Peloton stock to drop to $5 within this year. As everyone knows, during the pandemic, Peloton has actually boomed. So Left reiterated his earlier assertion that Peloton Interactive is a grossly overvalued product compared to its peers like Fitbit and Planet Fitness. The company, whose shares closed at $29.75 on Monday, will be worth $5 by the end of the year, Left claimed. The Peloton CEO replied to this, John Foley, and said, "Should have nothing to be ashamed of, as at $5 he will still have the most valuable exercise equipment company in the world." If we check out Peloton today, we're going to see the Peloton share price is now at $100 per share, and it actually boomed during this pandemic time. So across the last year, it went from $29, they shorted it, obviously in January they shorted it, went all the way down, and then now we're sitting at nearly 400% up. It's currently sitting at 260% up from that price point at $100 a share, and they predicted $5. So if we take a look here, this is an article on Business Insider where the famed short seller Andrew Left's hedge fund saw 43% returns in its first year. So this is what they do. They basically publish articles, free articles to read that are readily available to the public, and they see, good profits of it. Citron Capital, the new hedge fund led by famed short seller Andrew Left, gained 43% net of fees in 2019. The fund includes both long and short options, and in 2019 the average exposure was 75.8% long, 80.3% short. So yeah, he stuck against his bet to Peloton, and if he's been sticking to that $5 price target right now, he's down a lot of money, baby, because he's been trying to short it down to $5, whereas Peloton blew up and it's sitting around about $100 mark. So I don't know if he's still got that leverage trade open. It's going to look a bit juicy.
So what would we do in this position? Well, if they're actually shorting it and the momentum's coming down with shorts, I wouldn't know what to do. For me personally, I haven't invested in NIO yet, and if there's a drawback to maybe the $25 mark, I might take a position in NIO. But yeah, they're notoriously known for shorting the stock, and it's what they do, it's how they make their profits. So to release articles, free articles, and then short the stock, it's part of the strategy of how they make their money. That's Mr. Investor Lot. Thank you very much for watching. Please hit that thumbs up and please hit subscribe and leave me a comment. See you next time. Remember to do your own research at all times. Mr. Investor Lot, over and out.